Let's continue the conversation. Some earnings here to make you smile. A few of them, that is. Some of these earnings, others are giving concerns to investors and market analysts. So we've got to talk about that. These are all coming out of 2015, the year of a major political transition in Nigeria's 55-year history. So let's get Tola Bimbola from Afrinvest to talk to us. Good morning. Thanks for coming. We'll talk about a few earnings. We appreciate your time, oftentimes on Skype, but now it's good to have you live here in the studios. We'll talk about a few earnings. Just a few seconds. Give us a few seconds. We're going to push this out for our viewers to look at. FCMB, you may have heard that in the news. Gross earnings just 2% for 2015. Third quarter interim operating expenses almost by the same margin, but look at the loss after tax, the massive 85% before tax, after tax 87%, basic earnings per share a whopping negative 87%, net assets a negative 1%. Well, that's not much to worry about, but if you look at these numbers, what does it tell you and what are analysts saying about FCMB and what may likely run through other listed lenders on the market? Go to Forty Oil. This came last week. This oil major independent integrated retailer turning those numbers. You can see the revenue down because of the price of oil, especially, of course, you know, we do all the imports in dollar terms. Profit before tax plus 16.7. Net profit about 30% to the north. Basic earnings per share, that's quite significant, 86.8% to the north. Net assets grew 4.4%. That's as far as that sector is concerned. But look at the brewery sector, the second largest brewer, one of the two main rivals head-to-head, Guinness Nigeria, reporting all negative numbers. This will break your heart. Revenue down 10%, cost of sales off track 4%. Well, that looks some positive there for you. But if you look at the before and after tax numbers, that's all in the red. I look at the basic earnings per share as well, also negative. Net assets also down. International breweries, very small company, Southwest Nigeria, Ilesha to be precise, where is located. A small brewer reporting all green figures. Let's leave it at that. Let's bring it. Tola, give us your thought. Let's start with the banks. As always, some analysts are saying the negative numbers from FCMB largely because of its exposure to the oil and gas, the power sector, and the increased provisioning, more than 100% for loans in these books. Talk to us about this.
Yeah, that's correct. I mean, the general macroeconomic and regulatory conditions have not been helping banks to perform very well. And if you look at FCMB's number, they struggle to grow their gross earnings by just about 2% because basically their loan growth has not been that impressive. They grew loans contracted by about 8.5%, you know, as a top quarter of 2015. That's the gross loan. So when you look at that figure, that means that the interest income they will be earning from loans will be reducing. As a result of that, we saw just a mild 3% growth in interest income. Now, to their other operating activities, I mean, due to the FX challenges we are seeing in the market, that trading income has reduced significantly. When you also look at the fact that this is a group company, so I mean, their income from security trading has also declined because they'll be able to push a lot of volumes in a very down capital market.
When we say securities trading, we mean the stock market. Stock
markets, exactly. So now, going back to the pressure point on their bottom line, the fact remains that the bank had to make a lot. They made a lot of provisioning for their exposure to some very toxic assets. I mean, like you mentioned, they have exposure to the downstream oil and gas sector. They announced last year that they have a list. They had a list of bad debtors, and the total debt exposure was about 17.1 billion naira, and a chunk of that was to MRS, a downstream player in the oil and gas sector. So
MRS is also listed on the exchange.
That's correct. That's correct. So that's to make they made provisioning for that and for other toxic assets as well. So that was basically what led to the massive decline we saw in their bottom line. And even beside that, their cost to income ratio also has been increasing as well. You know, very high operational leverage, funding pressure as well. The cost of fund has increased significantly because they are paying more on interest expense. That is contracting their net interest margin. So overall, what really affected FCMB was a combination of the macroeconomic factors that led to a reduction in loan growth. I mean, overall in the economy, total credit private sector was about 3% year on year in 2015, relative to 11% that we usually experience, every year. So loan growth has been slowing. Regulatory pressure has tightened other income lines. So a combination of these factors is leading to the operating, weakness in the financial performance of banks.
Very strong headwinds there within the environment for this bank. Do you think this will be something that's likely spreading across that industry?
Well, for a number of banks, especially the tier 2 banks, things are going to get pretty difficult for them because they will need to make a lot of provisions and they have a relatively weaker capital buffer, and so that may affect the ability to pay dividends to shareholders and may lead to further downfall in their share prices. But for the tier 1 players, we think that they are very strong on capitalization. They have a very diversified operation, and for them, the likes of GT Bank, Zenith Bank, they will be able to pull through, although we expect that their performance for 2016 will be a bit weaker because of our softer loan growth outlook. So yes, it will get a bit difficult for them, but for the tier 1 banks who have very much more larger capital buffer, they will still be able to sustain investor interest and deliver very, if not that impressive performance, but acceptable performance. For the tier 2 banks, it will get really tough for them.
A quick one. Do you think it's still profitable? Does it still make so much sense to have so much securities trading on your balance sheet as a bank, considering the state of the market in recent years?
Yeah, the central bank has already guided against this. After the downturn we saw in the equities market in 2008, the central bank came out with a regulatory policy, a prudential guideline to ensure that banks don't use depositors' funds to play in the securities market. So they came up with this universal banking model. Most of the banks actually, had to comply with this, and most of them are actually much more exposed to their core business areas. But for some like FBNH, like FCMB and Stanbic, they chose the universal banking model, which means they have exposure to both securities trading in the investment banking arm and also their cooperation of giving loans to the real sector and investing in investment securities in their commercial banking arm. So for them, they may be a bit exposed, but the contribution of these investment banking operations to their overall income is quite weak. So that may not be the major pressure point. The major pressure point will continue to be the exposure to toxic assets, which may lead to write down on loans, and the fact that loan growth will be very slow in 2016. So that may also have impact on their interest income.
A quick one before we leave FCMB and the banking sector. If FCMB is able to get about that 17 billion naira back, claw it back from debtors on this balance sheet, you think this will hit it all up to the north?
It would. The share price is quite very low now, about 99 kobo, 99 kobo. That's why it trades that. So, if they are able to recover that loan, that will boost their EPS, northward. Analyze EPS as at the third quarter with this very poor result is about 49 kobo. If they're able to recover that particular amount back, EPS probably flies to around 75, 80 kobo per share. And look at the earnings yield, EPS, and the price it is currently trading at. So that would be very impressive for the bank. If they are able to recover those toxic assets.
Do you think I should be stepping into the oil and gas segment now with some of these stories coming out? Seplat on one hand, Forty Oil reporting better than expected EPS for the same, looking at 2015. Yeah. Does it look like with the end of petrol subsidy and the deregulation in that sector and the kicking around of the NNPC, getting that business cleaned up, do you think it's time to look into the oil and gas as part of my portfolio?
Well, both companies, they operate on very different performance level and landscape. For Seplat, they are more exposed to the upstream sector, and over the years, the company was able to diversify their operation away from just oil to gas. The Oben gas plant was opened last year, and they've been able to deliver very solid cash flow from their sale of gas to lifters like power companies and other operators and industries as well. So for Seplat, they've been able to reduce their exposure to oil, actually diversifying into gas has actually strengthened their operational performance. Although revenue is going to come in quite weak, year on year, but it should still be above most analysts' expectation. And yesterday they announced that they were able to also finish the acquisition of 2 oil blocks from Chevron. So that's very positive for Seplat. But for Forte Oil, the results look very impressive. But when you dig deeper to it, you discover that their turnover was down.
The revenue.
Revenue
Yes.
by about 26%. But because of their other income, the other non-operating income, the gains from foreign exchange, their freight operation for MPDC, and some other non-core operation, they've been able to actually bolster their
Non-oil trading.
Non-oil, exactly. Non-oil trading operation. They're able to actually bolster their, their income. But the thing about finance is this: these non-core operations, they are not sustainable. It's not something you get, year in, year out. Your operating income, that is what determines the strength of your company. So for Forte Oil, it's a very good performance at the bottom line level. But I mean, looking at the quality of the earnings, and I wouldn't say that it's either impressive. And looking at the share price now, it's still a bit overvalued in our opinion.
Okay. The next question: what do you drink? I wish I could offer you something to drink.
I take a lot of Maltina and have some water.
No, you're going to get charged for that from the commercial department if you mention any brand. But I'm just kidding here. So you're a non-alcoholic.
Okay.
Okay, so, which is good. But look at Guinness. Look at the brewery sector. Looks like, well, as you heard earlier, we're expecting Guinness, Nigerian breweries earnings to come out this week. Guinness is already out for its second quarter. Guinness year end is June. So this is about the second quarter for 2015. That means towards the end of the last year. That's what the figure we have here. Yeah, some analysts are already saying that Guinness is already going head-to-head with Nigerian breweries when it comes to one or two of their products. Nigerian breweries, Ace on one hand, Guinness Origin on the other hand, and it looks like there's a pressure there, and Guinness is really, really losing some weight here.
Yeah, I agree with you. And I mean, looking at the performance of Guinness for the last operating results they released for Q2 2016, we discovered that their earnings, their turnover actually is slowed significantly due to the fact that their the sale of origin, it has reduced quite significantly. I mean, typically in the yellowtail period, that's the period between October and December, the last quarter of the year, normally record very strong sales for their core brands like Origin, like Guinness. But this time around, Guinness sales was quite impressive, but Origin slowed down significantly, and that affected their performance. I mean, turnover was down by 11%, and also they also have very high operational leverage. Very inefficient cost model. Cost of sales and operating expenses did not decline as much as turnover declined. So that led to a massive drop in their PBT that we saw. But for Nigeria breweries, like you mentioned, Nigeria breweries is a very big company. It operates both in the premium space, in the middle, and also the discount.
That is where I'm going. The bottom line. How do you think these little companies, small companies like International Breweries, making all the grains while Guinness getting all the rates?
Well, I think the key thing to do is this: create a niche for yourself and defend your market share. That is what International Breweries have done. They operate basically in the southwest Nigeria. So that be very efficient cost operation model, and they will also actually deliver very solid performance. They sell they don't sell to the premium consumers, rather to the discounts, the lower tier of the market, and they will successfully defend that market share, concentrating on the southwest region alone, and that has yielded very positive results for them.
I guess I'm going to stop you there. I really apologize. Well, thank you very much for coming.
Thank you for having me.
When we meet again, I'm going to allow you to ask me what I drink.
Okay, I will do that.